Hi. Okay, these are all the past year exam question that you should do for homework after this lesson. And over here all these in numbers in pencils are the past year exam question that I'm going to go through with you now in this lesson. So what you should do is you should pause the video, go and get ready all these past year exam question in this order: one, two, three, 4, 5, 6, 7 in this order. Stack it up in this order, and we will start our lesson. Okay, so now we are at November 11, paper 2, question 5. So the question says, okay, so this is the question, and the question required: A, calculate the number of ordinary shares held by Mr. Jawa, his children, and other members of his family in Java Private Limited at 31 August 2011. So this is what the question is asking. Okay, so here it says the ordinary share of Java Limited is owned 95% by Mr. Java and 5% by his wife. The latest summary balance sheet at 30 June 2011 is as follows. Share capital, ordinary share of $1 each. So the shares is $1 each. So 4.5 million, this is in thousand, 4.5 million ordinary shares. That means also 4.5 million number of shares. So now I'm going to, as usual, my usual style. So you should have your question with you. So I don't need to flip to and fro. So have your question in front of you. So the question says the number of shares held by Mr. Jawa, his children, and other members of the family. So at 31 August 2011. So I'm going to do out my question nicely. So part A, at 31 August 2011, number of ordinary shares held. Okay, all figures are in thousands. Okay, and then I put over here workings. So Mr. Jawa, his children, and other members of the family. This is what the question says. Okay, so the first part of the question, 4.5 million shares. So Mr. Jawa holds 95%, and the children 4.5 million times 5%. 0.05 means 5%. So I do up this part first. Okay, so that means here I leave it blank first. So I do up this working first. Then I read on the additional information. Additional information number 1 says, on 1 July 2011, Java's wife left the company. Her shares went to her 2 children. Okay, her shares were valued at that date at 675,000. So at the beginning of the question, it says that Java holds 95% and the wife holds 5%, and the wife's shares goes to her children. Okay, the shares were, so now the question, you must be very clear what the question is asking. So you look at question part A. Calculate the number of ordinary shares. They are asking you to count the number of ordinary shares. So that means they don't want to know what is the value of the shares. Okay, all they want to know is the number of ordinary shares. So the additional information number 1 is not relevant to A because her shares were valued at 675,000. It's not relevant. It does not affect. We only need to know is the wife gave the shares to the children. So instead of Java's wife, now is this one the children. 4.5 million, all figures in thousand, times 5%. Okay, so the value is irrelevant to part A now. So number 2, on 10 July 2011, the company made 1-for-3 bonus share of bonus issue of ordinary share using appropriate reserves. So over here we are supposed to count the number of ordinary shares. 1-for-3 means for every 1 existing ordinary shares you get for every 3 existing ordinary shares you get 1 bonus share. So these are the ordinary, this 4.5 million times 95% is the ordinary shares. So 1-for-3, that means you get 1 more. So that means you times 4/3. That is because you times, why 4/3? Because originally is 3/3. That means originally is 1 proportion, but you get 1 more. So that means you are saying that 4.5 million times 95% plus 1/3 of it. That means you add on 1/3 to it. So mathematically will be times 4/3. Okay, because you get for every three existing ordinary shares, you get one bonus share. Okay, this is what the question means. So this one also times 4/3. So number 3, it says 31 July 2011, Java Limited issue for cash additional 2 million ordinary shares to its children at a price of 1.5 million. So the value, the price is irrelevant to this question. The question is asking the number of ordinary shares held. So issued additional 2 million ordinary shares to his children. So the number of ordinary shares added to his children is 2 million. So plus the 2,000, because all figures in thousands. So plus the 2 million here. Number 4, 1 August 2011, the company repaid. So this number 4, additional information number 4 is irrelevant to this question. Number 5, 9 August 2011, the company issued for cash 3 million ordinary shares to other members of the family at a price of $1.70. So the $1.70 is irrelevant to part A. So other family members, the number of ordinary shares held will be 3 million. Number 6, 30 August 2011, Java raised bank loan. So this is irrelevant to this part. Then the rest of the question is also irrelevant to this part A. So over here we solve this equation, then we get the number of ordinary shares held, then we total it, then we would have answer this part A of the question. Then part B, calculate the bank balance of the company's bank account at 31 August 2011. So you calculate the calculate the balance of the company bank account. So what I do is I do up the bank account, draw up the bank account. Okay, right here, bank account for 31st August 2011. So 2011 in $1,000 and $1,000. Okay, so now we look at the top of the question. It says bank overdraft 250,000. Okay, so all these figures are in thousand. So a bank account is a debit nature. Okay, this side is debit, this side is credit. So a bank overdraft is a credit balance. So that's why the balance brought down is on the credit side. Okay, so that means the debit side, which is this side, represents all the is the money come in. This side is the credit side, is the money go out. So now we got to see number 1 July, additional information number 1 July, Java's wife left the company. So this, you must be mindful. This is the company bank account. As stated in the question, calculate the balance of the company bank account. So this is the company bank account. So additional information says 1 July 2011, Java wife left the company. Her shares went to the children. The shares were valued at 675. So this 675 money did not come into the company. Neither did it go out from the company. So this is just the market price of the shares on 1 July 2011. It doesn't affect this company bank account, because to the company there is no for this number 1, there's no money come in or no money go out. Okay, number 2, on 10 July 2011, the company made 1-for-3 bonus issue of ordinary shares using reserves, appropriate reserves. So I have explained very clearly in lesson 4 part 1 that when you issue bonus share, the money did not go out from the company. Okay, so bonus share, it does not involve any cash flow to the company. So number 2 is not relevant to this question. Number 3, on 31 July 2011, Java Private Limited issued for cash an additional 2 million ordinary shares to his children at a price of $1.50. So from the question, we know that the par value of the ordinary shares is $1 each. So the company issued for cash 2 million ordinary shares to its children at a price of $1.50. So that means you debit bank 2 million, credit ordinary share capital 2 million. So the shares was issued at a premium. You know, the children bought the shares at a premium of 50 cents each. So 50 cents each times 2 million ordinary shares will total to 1 million. So so that means that in total 3 million, the children gave 3 million, you know, to the company, paid 3 million to the company. 2 million for the par value and 1 million for the share premium. So you credit share ordinary share capital 2 million, credit share premium 1 million. Okay, so that means 3 million came into the company bank account. You know, the children paid 3 million into the company bank account. So this is what happened on 31 July. On 1 August, the company repaid Mr. Jawa's director loan account. So this is money go out. Okay, so how much is the director's loan account? 1.2 million. Okay, so 1 August, so this side is money go out, 1.2 million. On 9 August 2011, the company issued for cash 3 million ordinary shares to other members of the family at the price of 170. Okay, so 3 million is the ordinary shares at par value. So the premium is 70 cents each times 3 million will be 2.1. So total, the other family members paid 5.1 million for the share. So that means, in other words, 5.1 million was paid into the company bank account by other family members. Okay. Okay, on number 6, 30 August 2011, the company raised a bank loan of 1.3 million. So 1.3 million is money come in. Because you borrow loan from the bank, 1.3, that means this 1.3 million money come into the company bank account. So money come in is this side. So 30 August, you got 1.3 million from the bank loan, so 1.3 million, and bought fixed asset for 7.4 million. So when you buy fixed asset, money go out. So money go out is this side. 30 August, fixed asset, 7.4 million. Okay. Then then this one. During the period 30 June to 31 August, the company made profit 1.95 before charging depreciation. Okay, this one let's hold on first. Then 31 August, stock debtors. On 30 August 2011, the company paid dividend of 6 cents per share on all ordinary shares on issue. So pay dividend is money go out. Okay, money go out is on this side. 30 August, dividend. Okay, dividend is 6 cents per share on all ordinary shares on issued on that date. Okay, so what are all the ordinary shares on issued on that date? Is what we have calculated here, 11 million. So dividend is 11 million times 6 cents per share. So the dividend paid is 660,000 over here. Okay, so then one more thing. You see, the question says, during the period 30 June to 31 August, the company made a profit of 1.95 million. So if you made a profit also, that will cause the money to come in. But the thing is, cash profit is different from accounting profit, so we have to make some adjustment. So we call this cash profit, we call it cash generated from operations. Okay, so we made some adjustment. Okay, 1.95 million, we made a profit of 1.95 million before charging depreciation of fixed asset of 620,000. Yeah, because depreciation is an expense, but there's no money go out. So 1.95 before charging, so we will take the figure before charging depreciation, before less depreciation. That is correct. Okay, we shouldn't take the figure, because the purpose here is we want to calculate what is the cash profit, the profit that reflect in incoming cash. Okay, because whatever profit you make, because some expenses are does not involve any cash outflow. For example, depreciation. So we are taking the profit figure before depreciation, which is correct. Okay. If after depreciation, then we have to add back the depreciation, because depreciation it's not a cash outflow. It's an expense, but it's not a cash outflow. So we take the profit figure before depreciation, which is 1950. Okay, now you see on 31 August 2011, stock were valued at 3650, debtors 2.5, and creditors 1250. So on 31 August, stock is 3650. Then on 30 June 2011, so that means we are investigating the period from 30 June 2011 to 31 August 2011. Okay, on 30 June 2011, stock was 3200, okay, 3002. But on 31 August 2011, stock is 3650. So the increase in stock would have caused a cash outflow because we make a profit of 1950, but the stock has increased by 450,000. So the increase in stock will be a cash outflow that would reduce your profit. So some of your profits that you have made will be taken away by the increase in stock. Okay, so if you think of it in a very simple manner, so let's say at the beginning of the year, so I'm making a very simple example. So let's say I make a profit of $100, $100. You see that is my accounting profit is $100. But at the end of the year, I have stock left of $20. So so actually that $20 unsold stock from the accounting point of view, it will be, when we calculate the cost of sales, will be opening stock at purchases less closing stock of $20. So that $20 increase in stock, it has actually reduced my cash profit. So my accounting profit is 100, but the increase in stock is $20. That's why my cash in hand, even though I make a profit of 100, my cash in hand is only 80. Okay, why don't you, for those who still does not understand, we will go through this in brief first, but when I go to the topic of cash flow, you should also follow closely the topic on cash flow in subsequent lessons, then you will understand this even better. Okay, so this one is, so the increase in stock will reduce your cash, is a cash outflow, the increase in stock. Then the debtors has increased by 700. So increase in debtors is also a cash outflow. So that means your this accounting profit before depreciation minus the cash outflow caused by the increase in stock minus the cash outflow caused by the increase in debtors, and creditors increased by 1250. So you see, creditors are people whom we owe money to. So that means we can say, in other words, creditors are those that we lend money from. Okay, because we owe them, so-called indirectly we borrow money from them. So that means you see the creditors figure increased by 300,000. So that means increase in creditor is a cash inflow. So that's why your profit before depreciation minus the cash outflow from the stock and the debtors plus the cash inflow from the creditors, this will be your cash generated from operations. So this is money come in. Okay, so we put this side. So you see which side bigger. So this side bigger, we put this 10,500 here and put the same figure here. 10,500 minus the rest of the figure, we get the balance carried down. So balance carried down is here. So balance brought down will be on 1st September will be this side. So that means it's a debit balance of the bank account. That means it's a positive balance. So balance of so I should answer the question properly. They say calculate the balance on the company bank account. Therefore, the balance of the company bank account at 31 August 2011 is 990,000 bracket is a debit balance, bracket debit balance. Okay, part C says prepare a balance sheet for the company at 31 August 2011. So Java Limited balance sheet as at 31 August 2011. So as I have shown you carefully before, previously, um, when you do a balance sheet, you do up the title first. For me, I put here two columns, okay, and then over here I try to save paper. I do it in one paper, but previously I've showed you that always try to space out, so you can use the previous method for your own. But over here, for easy presentation and easy tutorial, I do it all in one piece of paper. So so this is my fixed asset. Then I leave some space, current asset, so that will be one page. Then previously I've presented it this way: equity plus current liability plus long-term liability plus current liability. Okay, will be one page. But I can present it this way also. Okay, fixed asset, current asset minus current liability. Then I get current asset minus current liability is working capital. I have then I minus long-term liability. Then I get my net asset. Net asset should balance with equity. So this side will be equity. Okay, so then now I do up the easy figures. Share capital, ordinary shares of $1 each is all these are figures are in 11,000. Okay, share premium. How much is share premium? What is share premium? Okay. Um okay, share premium 1,000 plus 2,001, that is 3,000 3,001. Okay, so now we take a look at this here. Okay, the at the beginning, you see when you look at the top of the when you look at the beginning of the question, the share premium at first is 700. So I mean even following the sequence of the dates, so the share premium is 700,000. Additional information number one, this is not relevant. Additional information number two, the company made 1-for-3 bonus share using appropriate reserves. Okay, so the company issue 1-for-3. So 1-for-3 bonus share. So that means the number of shares at the beginning of the period is 4.5 million. So 1-for-3. So 1/3 of it. That means for every 3 ordinary shares they get one share. So for 4.5 million, the shareholders will get 1.5 million bonus share. So 1.5 million, 1.5 million bonus share. Okay, so this is 1.5 million bonus share. It was already added into the it was already this one is inclusive of the bonus share already. This share capital or at par value is already inclusive of the bonus share already. So the bonus share of 1.5 million, we can have the option of deducting from share premium account or from our profit and loss account, or this one we so call it retained profit. So normally what people says is we will deduct from share premium first. If not enough, then the balance we will deduct from profit and loss account. So the bonus share was made on 10 July 2011. So on 10 July 2011, the balance on the share premium account was only 700,000. Okay, the addition to the share premium account came later than 10 July 2011, 31 July. So on 10 July 2011, there was only 700,000 in the share premium account. So we deduct this for the bonus share, and the balance, okay, 1,005 minus 700, the balance 800 we will deduct from share premium account over here. So this is for the share premium account. Okay, minus 700, and the 3.1, the 3,001 is actually from the issue of share at a premium over here on 31 July and 9 August over here, 3.1 million. Okay, so that's how I get my share premium figure. Okay, the bank loan is 1.3. You see, I can easily dig the figures over here. So long-term liability, the bank loan is 1.3. Okay, so you see creditors is given at the bottom of the question. It say at 31 July stock were valued at 3650, debtors is 2.5, um 2005. Bank I have calculated from here 990, and then creditors is also given. Okay, fixed asset. See at the top of the question, fixed asset is 4002 plus we bought 74, so it's here. Then depreciation is 620, is given in the question also. Before depreciation of 620. So the depreciation should minus from the retained profit also. So you see this one equity, this one is the profit and loss account, means the retained profit. You look at the top of the question, at the beginning the profit and loss account is 1.6 plus 1950 is what the question given, the company made a profit 1950, then before depreciation, so I got to minus depreciation as well. Then this is for the issue of bonus share, and this is for the payment of dividend. Okay, payment of dividend is minus from the bank account and should be minus from the retained profit. So this is my retained profit figure. So that is how I get all the figures. So this is my net asset. So this is my working capital. This is my net asset will balance with my equity. Okay, so then we come to part D. Like, this is part D. Give 2 reasons for making bonus share issue. So this is what I explained before in part 1 as well. Make shareholders happy without incurring any cash outflow. And number 1, I put transferring balances from revenue reserves to capital reserves to lock in the funds. So give 2 reasons for making bonus share. Okay, so okay, so that means when I make bonus share, I'm actually transferring amount from revenue reserves into share capital, to transferring revenue reserves to capital, not capital reserve, to capital. Share capital is capital to lock in the funds. Because you see, retained profit is available for paying cash dividend. So when I issue bonus share, I'm actually transferring some amount from retained profit into capital, into share capital. And share capital cannot be distributed as a dividend or any form of cash. So and the company cannot buy back its own shares, as I explained before. So I'm actually locking in the funds into here. Okay, so as I go on, we can examine more reasons for issuing bonus share. But what can you think of? Okay, what can you think of why the company issue bonus share? So why does the company issue bonus share? What are some of the other reasons? Okay, so some students say increase supply of ordinary shares so as to reduce the market price of the share in order to make the ordinary shares affordable for purchase. It's correct also. Yeah, it's logical and it's correct. So you can add reasons that you think is logical and and uns- explain in a logical way. So the third reason that you can think of is to increase supply of ordinary shares in order to reduce the market price of the shares, to make the shares affordable to many. Okay, so to make the shares affordable. So number E, give 2 reasons why the director might prefer to make a loan to a company rather than subscribe for new shares. Okay, this part I would like to take this opportunity to explain more over here. Okay, so previously I've explained this. There's a group who are the owners of the company. So who are the real owners of the company? The ordinary shareholder are the real owners of the company. Then in between, then we have preference shareholders. Then after that we have lenders. Okay, so actually this is also very logical. So the real owners of the company are the ordinary shareholders. Then second, we have preference shares, which are in between owners and lenders. Then third, we have lenders, people who lend money to the company, for example, loan stockholder, debenture holders. Okay. So now, I ask you logically. Okay, we are thinking something like that. So now I ask you, okay, so you and your parents and your family members, okay, okay, so these are the people. Okay, so let's say you have a family business, okay, so your mother, father, everyone at home, they chip in money to for this family business. Then after that, you all have not enough money. Your family business borrow some money from outsiders. Okay, let's say come one day where the company want to close down. So that means any balance money in the company. So when you want to close down a company, you sell off a fixed asset, sell off a stock, and then convert it into cash. So this pool of money that it is in the company, what do you do with it? First, of course, you should pay off those people, those outsider that you have borrowed money from. Okay, those people who lend money to your family. Okay, of course you should pay the outsider first. Okay, then preference shares is sitting in between owner and lender. Then after that, you should pay off the preference shareholder. Then the balance money, then only you divide among yourself, your family members. Correct? So so it's a very practical and logical way that when we owe people money, we will always pay off the outsider first, you know. Then after that, any balance money, then only we divide among our family members, among ourselves, among the owners. Okay, so the company. So that's why I'm coming back to this question over here. E, give two reasons. You see, the company and the directors, a company is a separate entity itself. That means it's treated as under the law as if it's a separate person. Okay, so the company and the directors are treated as different entity or different person. Okay, so again, now we come back to the question. Part E of the question says, give two reasons why a director might prefer to make a loan to a company rather than subscribe for new shares. So if the director subscribe for new shares, he will become the shareholder. Okay, if the director lend money to the company, the director will become a lender. So in case the company closed down, or in case of bankruptcy of the company, whatever money that the company have should be paid to the outsider first, that is the lender. Okay, and then after that, any balance more money will give to the preference shareholder. When everything all the lenders paid off, the preference shareholder paid off, the balance will be divided among the ordinary shareholder in proportion of the number of shares held. Okay, so 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 that's why this is my answer here. His loan would rank in priority to the share capital in the event of bankruptcy. As such, as such, okay, as such, making a loan involves less risk of repayment. So in case of bankruptcy, the loan holder will get back all the money first. The company will pay off all the loan and pay off all the outsider first. Then the balance will be divided among the ordinary shareholders. Okay, as such, making a loan involves less risk of repayment. So what other reason can you think of? Uh, is it under normal circumstances, a company cannot buy back its own shares? Okay, so if you are a shareholder of a company, let's say you say I don't want these shares already, you can only sell the shares to other people, but you cannot sell your shares back to the company. The company, you cannot use the company money to give you the money and take back the shares. You can sell your shares to other people, okay, but you cannot sell back your shares to your own company. So if you cannot sell your shares to other people, nobody want to buy, then sorry, you got to keep the shares. That means your money will be locked in into the company. Okay, so if Okay, if the director subscribe for new shares in the company, his money would be locked into the company. The company should, but the company should repay the loan in due course, but the company cannot buy back its own shares. So that's why the director might prefer to make a loan to a company, because the company has to pay back the loan in due course. Let's say he make a 1 year loan to the company. After 1 year, the company has to give back the money to him. But if he subscribe for shares, the company cannot buy back his own shares. If he cannot sell the shares to other people, sorry, his money will be locked into the company. So this is how I'm answering the question. So I hope that as we progress along, you will get better and better, in this subject. So now can you come to the same year, November 11, paper 2, question 6A. So that means just flip to the next page. Okay, when I do a past year exam question, I would prefer to do the whole question. Like for example, this part, cash generated from operations. Some of you all may be able to grasp, but some of you all are still not very clear. But I'll make sure that I will be a lot clearer when I come to the coming lessons on cash flow statement. I will explain this much clearer. Okay. So this is November 11, paper 2, question 6A. Okay, 6B is not on company account, so I won't be going through 6B now. Okay, so this one, it says a new company has been formed to invest in a project that costs 25 million. Okay, the company wishes to raise 25 million on the financial market and has consulted you concerning the proportion of ordinary shares of $5 each and loan stock to be raised. Both ordinary shares and loan will be issued at par value. You have determined the rates of dividend and interest payable at various levels of capital gearing as follows. Okay, so capital gearing. Gearing means the proportion of borrowed money as opposed to owners' money. Who are the owners? Ordinary shareholder. So these are the proportion of gearing. Okay, this is the level of capital gearing. Percentage of total capital issued as loan stock. So percentage of total money issued as loan stock. Okay, loan stock is borrowed money, a loan. So 25% of this 25 million needed is by way of loan stock. Okay, so that means, in other words, the company needed 25 million. So what the question asking? Calculate the cost of dividend and interest at each of the projected level of capital gearing. So this is the projected level of capital gearing. Okay, gearing, you should know, is the proportion of borrowed funds relative to owners' money. Okay, company owners are ordinary shareholders. Okay, so this is a percentage of total capital issued as loan stock. So now you must think of a good structure first, otherwise you will be very disorientated. You don't know how to answer the question. Calculate the cost of dividend, okay, and interest at each level of projected level of capital gearing. So this one is interest on loan stock at each level of capital gearing. So this is my level of capital gearing. Okay, 25%, 50%, 80%. So the question wants you to calculate a cost of dividend and interest on loan stock. Okay, this I'm putting an additional info column, total financing cost. So all figures in thousands. So so cost of dividend. Okay, so 25% as loan stock. So that means the balance will be by way of ordinary shares. Okay. Okay, you read the question again. A new company has been formed to invest in a project that costs 25 million. The company which raises 25 million on the financial market has consulted you concerning the proportion of ordinary shares and loan stock to be raised. Okay, so that means they are calculating which one is more so-called cost efficient. Okay, both ordinary shares and loan will be issued at par value. So if they issue 25% as loan stock, okay, 25 million times all figures in thousand times 25%, so the loan stock is 8%. The interest for the loan is 8%. You see, as stated here, times 8%. So it's 500,000. Then ordinary shares, you will need 75%, 25% by loan stock, 75% by ordinary shares. Ordinary shares, we will pay dividend. So 25 million times 75% times 6%, 1125. So after you know what is happening, you see, it will be easy. So here 50%. So that means the dividend now is also the ordinary shares also 50%. 50% will be 12,500. 25 million times 50%, 12,500 times 8% is stated here. And 10% times 12,500. So I'm putting the total in this column. Then this one 80% is loan stock. 25 million times 80 times 20% will be 4 million. Then this one 25 million times the balance will be ordinary share 20% times 15%. So this is my total cost of financing. Okay. B, explain the risk associated with a highly geared company. Highly geared means high borrowing relative to share capital. High borrowings relative to owner's money. So what is the risk of high borrowing? Okay. A highly geared company may faces all the risks associated with over trading. Okay, over trading, it means too high borrowing that will result in high interest expense, and then high interest expense will result in lowering of profit. Lowering of profit will, if the profit lower, then you will need more borrowings, and it will thus lower profit even more, and it will result in a loss. And the cycle will go round and round. It will snowball, and after that the company will face liquidity problem. That means liquidity, that means no money. Okay, liquidity, no money problem, liquidity problem, and will require higher borrowings and higher interest costs. So this is over trading. Of course, you can answer in other ways. Okay, as seen in part A, the total cost of financing increase as gearing increase. A company has flexibility in determining yearly dividend payout based on profit generated. Okay, so that means ordinary shareholder, if the company make a loss, no dividend will be paid. But if the company make profits, okay, the company can determine pay some profits, but don't pay so many. So don't pay some dividends, but don't pay so much. Okay, but interest is a must. You must pay interest to your lenders. Okay, it's not a choice given. Okay, but interest payment on borrowing is compulsory, not negotiable. Okay, if the company is unable to pay the interest, it may result in more borrowings, thus leading to increased interest expense, and the cycle continue till there is a going concern problem. So this I'm explaining here. This is over trading. Okay. So these are the risks associated with a highly geared company. Okay, then now we will come to November 09, paper 2, question 3. Okay, get ready, November 09, paper 2, question 3. The directors of EBO Limited provide the following balances for a year ended 30 June 2008. Cost of sales and interest paid. Okay, 1 million ordinary shares at 50 cents each fully paid. So 1 million ordinary shares at 50 cents is the par value. The value will be 500,000. Okay, share premium 8% debenture. Prepare a profit and loss and appropriation account for the year ended 30 June 2008. Prepare a calculation of company share capital and reserves and long-term loans at 30 June 2008. Okay, so part A says prepare a profit and loss and appropriation account. So do up the structure for the year ended 30 June 2008. Here I put $sign. In the exam, no correction tape. Over here, sometimes I use correction tape, but in the exam, you are not supposed to So profit and loss and appropriation account. Appropriation account means how are you going to share your profit? Okay, profit and loss account. So sales. Then sales is the question you see got debit credit. So you know sales is a credit balance, and then cost of sales is a debit balance. Okay, sales minus cost of sales, then you get gross profit. Okay, then you minus operating expense, then you get your operating profit, then you minus interest expense, then you get a net profit. Then you add the retained profit brought forward. Retained profit, that means your profit and loss account at 30 June 2007, 1290. Then this will be your total retained profit available for appropriation, available for giving out as dividend. Okay, then proposed dividend on ordinary shares. Okay, that will be 1 million ordinary shares times 6 cents per share. So this is your retained profit carry forward. Okay, so you see the thing is sometimes A-level questions are not very clear. Here you see 8% debenture 2015. So I'm not sure if this 23,000 of interest paid includes the debenture interest. Otherwise, I should have calculated the debenture interest separately. So if the question is not clear, what do? You write assumption, write some notes and assumption. So that's why I actually include a note here. It is assumed that the interest paid of 23,000 includes debenture interest of 8%. Yeah, debenture interest of 8%. So if you take 250,000 times 8%, 250,000 times 8% is 20,000, but interest paid is 23,000. So I can assume that this interest paid is inclusive of this debenture interest. Otherwise, if it's not inclusive, then I have to calculate separately. So if the question is not clear, write your assumption. Okay, then part B says prepare a calculation of company share capital and reserves and long-term loan at 30 June 2008. So share capital and reserves and long-term loan. So as you know, debenture is a long-term loan. Okay, so share capital 1 million or 50 cents is 500,000. Share premium account is given in the question 300,000. Then retained profit is what I have calculated here 1822. So I put here. So total share capital and reserves, and then debenture is a long-term loan. So this is total share capital, reserves, and long-term loan. Okay, then part C. Okay, so it says here the following figures relate to the next year, 30 June 2009. Okay, so you have this one, cost of sales, debit, credit. So what is the question asking? Calculate the amount of ordinary dividend to be paid on 1 September 2009. So in order to calculate the ordinary dividend, so what has given in the question? Okay, the shareholders approve a dividend on ordinary shares for 30 June 2009 of 7 cents per share to be paid on 1 September 2009. So how many ordinary shares are there on 30 June 2000 for the year ended 30 June 2009? Okay, so I have to calculate what are the total ordinary shares at total 30 June 2009. Okay, as at 30 June 2008, as stated at the top part, the beginning part of the question, the number of ordinary shares is 1 million. Okay, the number of ordinary shares is as stated here is 1 million. Okay, that is at 30 June 2008. Okay, then now it says in the question, right issues of ordinary shares 300,000 shares of 50 cents each on 1 July 2008. So the right issues 300,000 of ordinary shares. So there's a right issue of 300,000 ordinary shares. Okay, there's a right issue of 300,000 ordinary shares. Okay, so the number of ordinary shares through the right issue is 300,000. Okay, on 1 July 2008. 2008. So that will give you the total. That is all the information that I can see over here. Mm-hmm. So this will be total ordinary shares at 30 June 2009. Dividend per ordinary shares is 7 cents. So ordinary shares to be paid on 1 September 2009 will be this one times this one will be 91,000. Number D. Okay, so right now I have not so-called cover ratio in details. But I don't like to. I prefer to like whenever I go through a question, I go through the whole question, so as to be more systematic, rather than skipping here and there. So what you should do now is you see, what you should do now is you can actually even go to my website, do your own company accounts, then here tuition A levels, okay, tuition A levels. Uh, okay, so here I have even put here the syllabus guide for you. Okay, here. Okay, so if you can't load, sometimes if you can't load, then you go to SEAB website to download the syllabus guide. Uh, okay, never mind. If you cannot download the syllabus guide over here, at the back of the syllabus guide, at the back of the A-level syllabus guide, uh, you you would you would be able to you would be able to see all the formulas for the A levels. So you should copy down the formula, okay? Like for example, part D, part 1. So the question say calculate the following ratios for each of the 2 years ended 30 June 2008 and 2009. In subsequent chapters on ratio, uh, the specific lesson for ratio, I will explain all the ratios thoroughly to you. But meanwhile now what you should do, you just in order to answer all these questions, you just copy the formula from the syllabus guide for all these ratio. So interest cover, net profit before interest over interest expense. This is from the just copy the formula first, and then from there you calculate. So net profit before interest. So you for 30 June 2009. So that means you calculate your net profit. You calculate your net profit. Okay. So net profit is your sales minus cost of sales, before interest minus operating expense. Okay, this one is also sales minus cost of sales minus operating expense. This is your net profit before interest. Then divide by your interest expense. Then you will get how many times. Okay, so earning per share also, for now just copy the formula. Net profit minus preference share dividend divide by number of issued ordinary shares. So take your net profit. Okay, this is your profit before interest minus interest will be your net profit. Okay, profit before interest minus interest will be your net profit over number of ordinary shares. This is number of ordinary shares. Okay, so then this will be your earning per share. Okay, then now we come to part E. Okay, calculate the following ratios. So similarly, ratios, before I explain in detail, you just finish up the question by copying the formulas from your syllabus guide. Okay, price earning ratio. So this is market price per share. Market price per share is given in the question. Okay, over earning per share. This is earning per share. So dividend cover, profit available to pay ordinary dividend. So profit available to pay ordinary dividend for 30 June 2009. So this is 344,000. How you get 344,000 is your net profit. Okay, 344,000 divided by ordinary dividend paid is 91,000. So dividend cover is 3.78 times. Then F, calculate the net asset value. Net asset. So net asset value of one ordinary shares. So net asset value is simply the net asset divided by the number of ordinary shares. So what is the net asset at 30 June 2009? What is your net asset at 30 June 2009? Okay. Net asset. Okay, remember just now when we do one balance sheet, the net asset is equal to your equity. Equity means your share capital plus all your reserves. Reserve, that means including retained earning. So net asset will be equal to share capital and reserves. Share capital and reserves. So share capital plus the reserves plus net profit minus dividend. Okay, so you get your net asset. This is your net asset, okay, which is equals to your equity, your share capital and reserves, 3305. Then divide by the number of ordinary shares. So this is the net asset value per ordinary share. Okay, so this is part F. Then part G says compare the performance of the company in 2009 with that of the previous years. So what is that? In general, the performance of company has deteriorated in 2009 compared to 2008. Net profit deteriorated, okay, which represent a 42% reduction despite sales increase. Gross profit reduced, then gross profit margin reduced. Okay, situation made worse with increased operating expenses. So this one just compare and write logically. An increase in interest paid. Okay, reduction in reduce become even sharper due to the right issue of ordinary shares. Reduction in earning per share become even sharper. Okay, so that means if there are more shares, the earning per share will become lesser, because that means if there are more shares, if there are more rights issue that will result in more shares, then the earning per share will become lesser. Less man, more share. I mean more man will be less share. Okay, more people to divide. More ordinary shares will be less earning per share, which dilutes the reduced earning. Okay, then now we come to November 09, paper 1, question 2. Okay, all these are actually theory question which will test your ability to put into writing what you understand. Okay, what you understand. Okay, so explain a right issue. A right issue is an invitation extended to the current ordinary shareholder of the company to purchase ordinary share at below market value. Okay, so the shareholders will be given an option to purchase the right at a predetermined price, and the number of rights available for the purchase are in proportion to the number of ordinary shares held. For example, 1 right for every 5 ordinary shares held. The price of the rights plus the special price to purchase the ordinary shares. Yeah, sometimes is it the price of the right bracket, if any. It is sometimes the company may not give the rights to the ordinary shares for free, to the ordinary shareholder for free. Sometimes the company may offer to sell the rights to the ordinary shareholder. That means there is a value to the rights also. Okay. The price of the rights bracket, if any, sometimes it can be given for free. Sometimes the company can sell the rights to the existing ordinary shareholder, plus the special price to purchase the ordinary share with the right would be lesser. It would be less than the market value of the ordinary shares of the company, thus benefiting the shareholder. The rights can be transferable and have an expiry date. Okay, what I want to add on over here is, in the exam, please don't leave things like this blank. So you see, after going through all this lesson, you have already understand what is right issue. Okay, so whatever it is, put your understanding logically in writing. Uh, it, it, I don't have perfect English. Sometimes I do have grammatical mistakes. But now you are not answering an English paper. This is an accounting paper. Okay, you can. Some of you could have a very broken English, but you can write in simple English and in a way that you can understand. Write, explain what you understand logically. Don't keep your answer blank. Okay, explain what you can. Explain what you understand logically and in a simple manner. Okay, identify two advantages and two disadvantages of a company using this method to raise additional capital. So sometimes to lay out, you just put one column advantages, disadvantages. So two advantages, one, and then you leave some space, put two. Okay, so rights issue, what's the advantages of rights issue? It's a cheap way to raise capital compared to issuing new shares to public. So if yours is a public listed company, if you want to issue new shares to the public, it's very unfair if you just ask anybody in the public to buy shares in your public listed company when people don't know about your company, correct? They don't know what this company is about. So just simply buy. So in order to issue new shares to the public, the public listed company should advertise in all the officials in some of the main officials newspaper the information about the company. Yeah, the information about the company. And since public listed is a very big company, they would need a very like proper procedure for public to subscribe the new shares. This is a very expensive procedure. Advertising in the one page Straits Times, you see how much? I think it's maybe $10,000 or more just for one day advertisement, correct? So it's a very expensive affair. So but if you issue rights issue to your existing shareholder already know about the company. So you don't need to go and advertise uh, uh, information about a company to the existing shareholders because they already know about a company. So it is a cheaper way to raise capital compared to issuing new shares to public. Okay, disadvantage. Okay, wait, we go through the advantage also. As rights issue are only offered to the existing shareholder, the number of ordinary shareholder would not be increased. Therefore, the voting rights of the original shareholders will be maintained if they take up the exercise right. Okay, some student simply can even write better than me. Okay, you can even write better than me. Um, okay, okay, so some students write not to dilute control within the company as the rights are only offered to the existing shareholders. Thus, 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 issuing rights issue does not significantly increase the number of different shareholders, the number of new shareholders into the company. Okay, so that means that means it does not dilute the politics. You can even say it does not significantly affect the politics within the company. Correct. So that means, for example, your public listed company is only dominated by a few of these people, or a few of these family members or friends that you all know each other very well. So if the rights issue are issued to the existing ordinary shareholder in that proportion, so so that so the we are not getting more people to come in to mass in to join the company. Thus, during the meeting when uh, there's an election of management, it will not create havoc there where new people coming into the company and have a say in the company. So that what it simply means. So this is how I put it. You can put it in your own way. Some student can even explain better than me. So So I'm just putting it, my suggested solution, that's why I'm just saying it is a suggested solution. It's not the answer itself, because some student actually can produce better answers than me. Okay, so I'm just giving you an example of how to answer the question. Okay, disadvantages of rights issue. This would normally cause a fall in market value per ordinary shares of the company due to increased supply of shares. So, so if you give rights issue, there will be more ordinary shares. More ordinary shares, that means the market price for the ordinary shares will fall. Okay, so if increase in supply, the price will fall. The general public may think that the company is in trouble, thus creating a negative proportion of the company, as the company is offering the shares cheaply, making potential investor disinterested in investing in the company. So rights issue, that means they offer the existing ordinary shares to buy the share at a cheap price. So that will create impression to the general public. Oh, the company issuing cheap share. Since the existing ordinary share can buy the share at $5 each, why should I buy at market price at $11? That's what people will think. So so this is what I think. So I put it in this question. So now we come to November 09 paper 1, question 4. Okay, so the question says, give 3 reasons why a company might issue a bonus share. So again, same story. Okay, I will write what I can think of to increase the voting rights of the current ordinary shareholders. So if you issue bonus share, that means more ordinary shares given to the current shareholder. So the current shareholder will have more voting rights. So sometimes a company, so this can prevent the company from being taken over by some new investor who buy a lot of shares in the company. So we are increasing the current, we are actually protecting the current ordinary shareholders. So this is the same story, increase to make shareholder happy without incurring cash outflow, to turn reserves into ordinary shares as the company might have too much reserves. So this is what I have explained before. So part B, prepare a balance sheet extract at 1 September showing the capital and reserves after the bonus issue has been made. Okay, after the bonus issue, the directors of Knorr Limited decided to make bonus issue of 1 ordinary share for every 5 ordinary shares held by the shareholder. Okay, so this is my so this is my answer here. Knorr Limited balance sheet extract at 1 September 2009. So capital and reserves. Ordinary shares of 25 cents fully paid. So here this part is my working. Okay. So over here number of ordinary shares is 1002. So here says the issue, okay, bonus issue of 1 share for every 5 ordinary shares held. The par value is 25 cents each. The value is 1.2 million. So first I must find out what is the number of ordinary shares. 1.2 million divided by 25 cents. That the number of ordinary shares is 4.8 million. The company made 1 for every 5 ordinary shares held. 1 bonus issue for every 5 ordinary shares held. So how many shares is the bonus issue? 4.8 divided by 5. So the bonus issue is 960,000 number of ordinary shares. So what is the value of the bonus share? Value of the bonus share is 960,000 times 25 cents is 240,000. So therefore the ordinary shares, the value of ordinary shares is 1.2 plus 240. And then profit and loss account is 60. You know why this 240? This 240, okay, 150 plus 70 is how much? Is 220. 200, okay, so 240 would be debited from share premium, debited from general reserve, and debited another 20 from profit and loss account. Okay, so you see 150 plus 70 plus 20 is 240. So that's why a profit and loss account left 60. Okay, that is because this one will go inside here, this one will go inside here, this one 20 will go inside here. Okay, normally we will get you see here capital and reserves, ordinary share, share premium, general reserve, profit and loss account. Okay, you look at the sequence here. Okay, you see from the bottom, normally this thing will be arranged in this way. The most bottom one is the most distributable reserve. As you go up, it will get more and more undistributable. Okay, what does this mean? You see, ordinary share is the most undistributable because the company cannot buy back its own shares. Once you are ordinary shareholder, your money will get stuck here. If you don't want the ordinary share, you can only sell to other people. You cannot sell back to the company. Share premium can use to pay bonus share, but cannot be used to pay cash dividend. General reserve can be used for cash dividend and also bonus share. This one retained profit also can be used to pay cash dividend and bonus share. That's why the below one is more distributable. As you go up, it gets more and more undistributable. That's why it's arranged in this order. So when you pay bonus share, normally we will take from the more undistributable one. Because we will leave more, it's logical because we will leave more amount in this retained profit so that it can be used to pay cash dividend. Then we will have more flexibility. Okay, if we want to pay dividend later, we still can pay from retained profit here because there's still amount here. Okay, so that's why we will, when you issue bonus share, normally that's why it's even said here. You see, it's specifically even said here. The directors of the company wish to keep their reserves in the most distributable form. So we know that retained profit is the most distributable. As we go up, it gets more and more undistributable. So that means we will take away from the more undistributable one first, and then leaving balance in the most distributable form. Okay, so this is total capital and reserves. So I've answered part B of this question. So now we come to November 03. Actually, it's quite the same story. I mean, that's why I answered for you a few questions over here. When you do all the homework later on, it's actually more or less quite the same story. An extract of the balance sheet of GNU Private Limited shows as follows: share capital and reserves. Okay, 480,000. The shareholder has written to the company secretary to ask if the board of directors can resolve to pay increased dividend this year, especially as the company has reserve of 330,000. How you get 330,000? You add all this, you get 330,000. That means 480 minus 150, that is 330. That means all this add together will get 330. So the shareholder asks, why? I mean, normal people want money, so dividend is cash money. So they ask the company secretary to ask if the board of directors can give us more money, more dividend. Okay, so that means I'm just recapping what I have explained to you in part 1 of the question. So 4 points. Under the law, share capital reserves cannot be distributed as dividend. So under the law, share premium and revaluation reserves are capital reserves. So these two cannot be used to distribute as dividend. Property replacement reserves. So all these when the question asks common sense question, please answer the question in logical common sense as well. Okay. So don't leave this kind of question blank. Answer it and you are likely to get full marks. Property replacement reserve, as the name implies, was created for the purpose of reserving funds for replacement of property or for the business operation. and should be used for such purpose, and therefore it is not appropriate to use these funds to pay dividend. General reserve was set aside for rainy days. It is a fund to stand by for any urgent needs, expansion, or any other general needs of GNU PTE. If it's used to pay dividend, GNU will be deprived of this fund. And then profit and loss account can be used to pay dividend. The board of directors can consider paying more dividend out of this account. However, it should be noted that the amount in this account is not huge, so it can be more dividend can be used to pay from this account. So they are just asking you to to reply to the shareholder. So just reply with your understanding and logically. So now I come to 03 paper 1 question 8. Okay, so now the question says prepare a trading and profit and loss account and balance sheet. Okay, as usual, you should draw the structure first. So I know the question want me to prepare trading profit and loss account and B balance sheet. So C is a theory question. So trading profit and loss account for a year ended 30 September 2003. Previously, I've explained to you very slowly how to do. So now I'm going faster. So and then this one, draw up the structure first. Lionheart Limited balance sheet. So fixed asset, current asset, then here I get total asset. Then shareholder fund and reserves, then long-term liability, then current liability. Then here, this is total shareholder funds and reserves. You can do it in 2 pages, space out. Okay, so now do all the easy question. So stock at 30 September 2003. So year end closing stock is 85,000. So this is 85,000. And here under current asset stock 85,000. Okay, then here depreciation for the year is provided 25% based on cost of motor vehicle, 20% on written down value of plant and machinery. Provision for doubtful debt 5%. Director proposed 3 cents per ordinary share and transfer 15,000 to general reserves. So ordinary share here, I put here ordinary shares. Okay, get your question paper with you. So general reserve, originally general reserves is when you look in the question, general reserves originally is 85. That 85,000, they said transfer 15,000 to general reserve, so will become 100,000. Retained profit, okay, retained profit, okay, wait first. Okay, so then, so all your premises, 325, plant and machinery, so this one you get from our question, premises, plant and machinery. And then motor vehicles is also from the question. Then okay, beginning of the year depreciation is how much is actually given here. Okay, this one is depreciation on plant and machinery. Okay, so you see how I do this is 75 minus 31 is 44. So this is the accumulated depreciation. Okay, how you get 31,000 is because depreciation, accumulated depreciation at the beginning of the year, according to the question, is 20,000, and depreciation charge during the year is 11,000. That will give you 31,000. Okay, so this is my accumulated depreciation. So the cost minus accumulated depreciation will be my net book value. So this okay, so how I calculate it, that 11,000, this one 11,000, okay, 50,000. So the question says motor vehicle is 25% on cost. So 50,000 times 25%. 50 times 0.25 is 12,000 12,500. And then the plant and machinery is 20% on written down value. Written down value means net book value at the beginning of the year, okay? Net book value at the beginning of the year. So you take 75,000 minus 20,000 is given in the question. Depreciation, the accumulated depreciation at the beginning of the year. So that is the net book value at the beginning of the year. Net book value of the beginning of the year will be 55,000 times 20%, so that will give you 11,000. So this is the depreciation charge for the year. Okay, you can, in order not to be confused, you can disregard this column. So this 23,000 will be my depreciation for the year. My cost minus my accumulated depreciation, I will get my net book value over here. Okay, so the question, the debtors 62,000, provision for doubtful debt according to the question is 5%. So 62,000 times 5% will be 3,001. Okay, and then so 3,001 is your provision for doubtful debt is to be adjusted. Okay, provision for doubtful debt is to be adjusted to 5% on debtors. At the beginning of the year, the provision for doubtful debt is 3,006, but now it's adjusted to 3,001. So it's a good thing, isn't it? That means the provision needed to buffer for debtors that eventually won't pay has reduced from 3,006 to 3,001. It's a good thing, yeah. See, the debtors is people owe me 62,000 minus this is what I think that I should provide for, because this is, you know, I should make a provision for just in case some people don't pay. So this is my net debtors that I think is collectible. So from 3,006 that I have previously provided for, or is brought forward from last year, it has reduced to 3,001. So actually I made $500 is so-called like a profit. Okay, so your gross profit at reduction in provision for doubtful debt, 500. So this bad debt is also gotten from the question. Wages and salary also easy gotten from the question. Debenture interest. Debenture interest is stated there 4%, but the question, you see in the question here says 8% debenture interest. So they could be testing me on my knowledge on what is 8% debenture interest, and I don't know whether it could be that this debenture was issued in the middle of the year. That's why the debenture interest is only 4,000. So I don't know what is it, or is it the debenture was issued at the beginning of the year, and therefore the debenture interest is supposed to be 8,000, 100,000 times 8%, 8,000, and 4,000 remains unpaid. So I don't know. So I have to write an assumption. That's why I put here note 1. Note 1, it is assumed that no adjustment needed for debenture interest, even though debenture carry 8% interest, which should be 8,000. It could have been issued in the middle of the current year. No details were available in this question. So if the question is not clear, please write your assumption. Okay. Okay, so all these are given in the question. So, and then this one I've explained to you. Sales is also actually very easy. Just copy from the question. Opening stock also gotten from the question. Purchases also gotten from the question. And so is closing stock. Then you get gross profit, and then all these expenses is gotten from the question. You get net profit. Then you add the retained profit brought forward. Then less ordinary dividend proposed. Okay, notes number 4 say the director proposed a 3 cent per ordinary dividend, per ordinary share. So how 3 cent per ordinary share? So that means you must calculate. You will calculate how many ordinary shares. 200,000 is the value. 25 cents is the par value per ordinary share. So the number of ordinary shares is 800,000. Dividend is 3 cents per ordinary share. So proposed dividend is 24,000. So net profit at retained profit brought forward. This will be a profit available for appropriation, profit available for giving to shareholders. minus ordinary dividend proposed. Okay, so this will be your retained profit. Then less 15,000 transfer to general reserves. So your retained profit carry forward will be 38500. So 38500 will be over here. Okay. Then debenture 100,000 long-term liability is also given in the question. Quite easy. So creditors is also given in the question. Okay. Bank overdraft also given in the question. You see the bank balance is on the credit side. So this is testing you on whether you are careful or not. So this is debit, this is credit. So bank is on the credit side, so it's a bank overdraft. Okay. Bank overdraft, current liability. Okay, then proposed dividend. Proposed dividend, that means the dividend that is proposed, that is promised, so-called, in a way, suggested dividend, suggested, but not confirmed. That means it's not paid yet. If it's not paid yet, that means it's owing. Is owing to the shareholder. So it's a current liability. Okay, so put under current liability. That means the company owe the shareholder so-called the company owe the shareholder 24,000. So it's under current liability. So then I get here. So if you want to know slowly step by step how to do it, I have already shown in a video how to do a balance sheet and profit and loss account slowly step by step. Okay, lay it out. So over here I'm just explaining to you quickly. So okay, so this one. So then part C, explain what factors Lionheart should take into consideration in deciding how to finance a planned expansion. The choice is between issuing 800 ordinary shares of 25 cents at par value or issuing 200,000 debentures dated 2025 with an interest of 10% per annum. State any assumption you were made. Okay, so I won't be reading to you. This is how I write. Actually, this is so-called quite similar to the previous question. All the past year exam questions so-called will repeat. 2014 has just finished. Some students say it's difficult, but I can pinpoint it out as I've written in the website. I can pinpoint out that all the question that I mean virtually all the question that came out before in a similar way. So as I explained to you, don't take it that, oh, very easy, this one, never mind, no need to practice, very easy. So, but when the exam come out, wow, so difficult, but actually the question came out before in a similar way. Okay, so I will go to the next question. You can pause the video and read it slowly, copy down some of the important ones, and I'll go to next question. Okay, this one 2008, the new syllabus of 2008, paper 2, question 3. Okay, you see, this one came out in 2008, and a similar question came out in 2014, and students don't know how to do. I mean, quite many students find it difficult and don't know how to do. That is because you see the don't take. I mean, you should practice very thoroughly all the past year exam questions. So part A says prepare the share capital and reserve of the balance sheet for Phoenix at 31 May 2007. Okay, the director says the company is too highly geared. Explain what is meant by gearing. Give two advantage of high gearing. So this is also what I have explained before. Okay, so now it says prepare the share capital and reserve at 31 May 2007. Okay, so share capital and reserves. The company had a difficult year to 31 May 2007, and after writing off discount on loan stock to the share premium account. So you have understood what is a share premium. That means you issue share at a premium, at higher than par value. Loan stock also have par value, and what is discount? Discount is opposite of premium. That means when a company is having in trouble or something like that, then you have to lay long sell your ordinary share. If you sell at par value, also nobody want, because now the company have bad reputation, got this and that. So people are scared. Wow, if I invest money, buy ordinary share in this company, later the company bankrupt, then I lost all my money. So the company so-called have to beg people to buy the ordinary share even at a par value. Par value also cannot sell. So have to sell below par value, have to sell at a discount. But the company can only issue share at a discount if the share premium can cover that discount. Okay? If there's not enough balance in the share premium to cover the discount, to cover the shortfall below the par value, cover the so-called discount, the company cannot issue any more share at a discount. Okay, if they issue loan stock, also can be deducted from the share premium. If they issue loan stock at a discount, also can also deduct the amount from the share premium. Okay, after writing off the discount on the loan stock to the share premium account, made a trading loss of 1.4 million. The directors agreed to pay interest due on the 9% debentures and agreed with the holders of the 10% unsecured loan stock. Unsecured means the loan stock is given, so that means the unsecured means the people lend the money to the company and then get 10% interest. But if the loan is not charged against any specific asset of the company. So your HDB loan, when you buy your HDB flat, you get the loan from HDB. So is that HDB loan secured? Your HDB loan is a secured loan, because just in case you got no money to pay the installment, the HDB loan installment, the HDB can seize your seize your asset, can seize your HDB, or let's say your private property is you buy a private property, a bungalow or an apartment, and you get a bank loan to mortgage. You get a mortgage loan from the bank to pay off this property. That loan, that mortgage loan is secured, because just in case you got no money to pay the housing installment, the bank can take away can seize your property. That means the property is secured on the loan. That means the property is so-called is not yours until you are fully paid the loan. The title, the title deed of your property is with the bank. The bank so-called hold the ownership of your property unless it's fully paid. That is called secured loan. Okay, unsecured loan, that means it's opposite. That means for example, it won't happen, but for example, the bank give you an unsecured loan on your property, so you hold the title of the property. It's just based on trust. In that way, the bank give you a loan. So if you cannot pay your mortgage, the title of the property is still yours. Okay. In reality, it does not happen, because bank won't be so stupid to give you an unsecured loan on your property. But okay, in this case, the question says that the directors agreed to pay interest on the 9% debentures and agreed with the holders of the 10% unsecured loan stock. So the loan stockholder lend the money to the company, and the loan is not secured, and they would receive their arrears on interest out of next year's profit. No dividend were to be paid. Okay, question like this, it sounds a bit confusing. That's why you should make it more clear by writing your assumptions, clarify it. Okay, prepare the capital and reserve section of the balance sheet of Phoenix at 31. So part A is not confusing. So capital and reserve section. So this is 600 ordinary shares at $1 each. So issued at a premium, right? So but still this one you put at the par value. So the share premium account. So I'm calculating the share premium account. So this share is issued at a premium. So how much is the premium? 600,000 times 25 cents premium. So 150,000. 700,000, 6% cumulative preference shares of $2 issued at $2.10. So here I put a par value. 6% cumulative preference shares. This is the par value. Okay, 700,000. So this will be 1.4 million. How much is the share premium? 6% cumulative preference shares at 10 cents premium. Okay. Then this one issue at par. So this one is issue at par. So no issue. So I just $1.50 times times 900,000. That will be 1350. Okay. So this one is premium. Okay. This one. So this is my share capital and reserves. Loan stock and debenture are long-term liabilities. Okay, but I have to calculate the. So this one they are saying that the discount is stated here that the discount on the loan stock is written off against the share premium account. Okay. So 10% unsecured loan stock issued at a discount of 1%. Okay. 1.2 million. So how much is the discount? 1% is 12,000. 1.2 million times 1% is 12,000. Written off against the share premium account. So share premium is 208,000. Okay, loss for the year. Loss for the year, the trading loss as stated here. Okay, so because share capital and reserve, the loss for the year will be under share capital and reserve, will be included in the share capital and reserve. Loss for the year, the trading loss, as stated in the question, 1.4 million. Okay, you see, if this is a loan, that means if for any interest on long-term liability, it has to be deducted against profit. Okay, so this is a trading loss before interest. So trading loss minus the debenture interest, okay, 3 million times 9%, and provision for interest on loan stock. They said it will be paid out of next year's profit. So I clarify it in this question. So I put a star. You can put it under assumption. Also here put a star or put bracket note 1 or something like that. This need to be provided for even if it were to be paid out of next year's profit in order to be prudent. So this is interest on long-term liability. It has to be accrued or provided for even though it is paid out. It will be paid next year. Correct? Okay. So this is the general accounting policy. You have to be accrued for, even though it will be paid next year. That's why I clarify it. Okay, so my loss for the year, 140,000. So these two add together is 390. Will be 1790. So I put here. So this is total share capital and reserves. So this one, part 2. What is meant by gearing? Give two advantages of disadvantages of high gearing. Okay, so what is meant by gearing? Real owners of the company are ordinary shareholder. Gearing refer to the way the company is financed, whether by outsider, which are preference shareholder, loan stock and debentures holder, or by the real owners, which are the ordinary shareholders. Okay. Company is said to be highly geared if its finance if the financing mainly comes from outsiders. So this is another way of writing it. Previously, I've explained to you another way, so you can write in a proper way, answer the question. Two disadvantages of high gearing. Interest have to be paid, which would wipe out a lot of profits or make greater loss. Okay, that means high borrowings, high gearings. High risk of bankruptcy because if the outsider financer cannot get their interest or dividend, they will want to withdraw or redeem their investment within the company, with the company. So if you lend people money and then they don't pay interest, you will say, give me back my money, redeem back, because the company have breached your contract. Okay, and then that would bring the company to bankruptcy, high risk of bankruptcy. Okay, part B. This is part B. So in short, what part B says: prepare a profit and loss account. Profit and loss appropriation account showing interest, dividend, and in dividend paid for the year ended 31 May 2008. Okay, what here says: 1 June 2007, some new directors were appointed and agreed to subscribe for immediate issue of 4 million ordinary share, $1 at $1. The company had a much better year and made a trading profit of 3.1. The 31 May 2008, the directors agreed to pay all interest due, including the arrears. They also agreed to pay the preference shares that were due with a dividend of 10 cents on each of the ordinary shares and a dividend. This transaction was completed on 31 May 2008. On 31 May 2008, the company repaid 500,000 of the 10% unsecured loan stock. It also purchased net asset from another company for 800,000 by issuing 350 ordinary shares fully paid. This new issue of shares did not rank for dividend in the year 31 May 2008. Okay, so part B asks you to prepare a profit and loss and appropriation account for the year ended 31 May 2008. So, so so I do the title underline, do the two column. Trading profit for the year is 3.1 million. Okay, so that means we go step by step. Previously, I've explained to you. So you know, we always should take care of the outsider first, correct? So interest expense, we will always pay the outsider first out of the profits. Okay, so there's no doubt on this. So less interest expense, 10% unsecured loan stock. So unsecured loan stock, um, so that means the interest on unsecured loan stock. How much is the unsecured loan stock? Okay, unsecured loan stock is 1.2 million. So the interest expense will be 10% of this. So how much is 10%? Then less 10. That will be 120,000. Okay, 9% debentures. 9% debentures. Mm. So how much is 9%? 3 million times 9%. 3 million times 9%, that will be 270,000. So this is the interest expense. Okay, 300. So net profit, this will come to net profit of the year. So the profit will less interest expense, then you get net profit for the year. Then you take your accumulated loss brought forward. This is your accumulated loss brought forward. Then this will be a profit available for appropriation. Okay, so then now I want to explain to you a bit more on preference shares. Okay, preference shares, as I have said earlier, it is a blend between long-term liability and ordinary shares. They are actually a class of shareholders, but they are preference shares. So that means they are ranked in priority when the company get bankruptcy, and preference shares also rank in priority of ordinary shares when it comes to dividend. So if the company have profits, first it must pay the preference shares holder first. Then any balance profit will go to the ordinary shareholders. Okay, so preference shareholders, we also have cumulative and non-cumulative preference shareholders. You see, in the previous year, the company was making a loss. So, so okay, non-cumulative preference shareholder. Sorry, when the company make a loss, non-cumulative preference shareholder won't get any dividend. This is 7%. We don't call it interest. We call it dividend. Preference shareholder, preference dividend. Okay, and it won't be accrued. The dividend for non-cumulative preference shares in arrears would not be brought forward for next year. So in the year of loss, the non-cumulative preference shares dividend will be lost forever. For cumulative preference shares, in the year of loss, they won't get any dividend, but the dividend will be carried forward. So what if for the next 10, 20, 30 years until the company get bankrupt, they are still making loss for the next 30 years, for example. Okay, so the cumulative preference shares dividend will be carried forward, accumulated for 30 years, 40 years, whatever, until the company get bankrupt. So you see, if the company keep making losses year after year, the cumulative preference shareholder cannot sue and say, cannot bang on the company, send a lawyer to the company director saying that, hey, you owe me dividend, quickly pay me. Cannot. If it's long-term liability, long-term debt holder, long-term loan stock and debentures holder, yes. Okay, that means it is compulsory for the company to pay the interest on long-term debt. Okay, not this one unsecured loan stock and debentures. If they don't pay, the long-term debt holder can sue the company. But cumulative preference shares, if the company year by year, every year, every year make loss, the cumulative preference share will have no dividend and they cannot sue the company. Okay, so that means the cumulative preference shares holder is like, if the company make losses year after year, it's not compulsory for the company to pay all their dividends in arrears, and the cumulative preference shares holder cannot sue the company. Okay, so but when the company make profits, Okay, so the arrears for the non-cumulative preference shares dividend will be lost forever. But for the cumulative preference shares, um, the so that means the arrears on the cumulative preference shares, um, uh, arrears on the cumulative preference shares will be paid first. Okay, the arrears, the earlier one will be paid first. Okay, if they are 2 years earlier arrears, the earlier year one will be paid first. Then after that, the current year cumulative preference shares dividend will be paid. Okay. Then after that, only the current, only of course the non-cumulative, the earlier year ones won't be brought forward anymore. It's lost. Okay. Then only you pay the current year non-cumulative preference shares dividend. Okay. Okay. Still got, after this one minus all the dividends, still got balance. Okay. Still got positive balance. Then this one I will use to pay the ordinary dividend. Okay, then this will be the retained profit carry forward. In 2014, a similar question came out, but I think there are some places that are a bit confusing and not clear. So like what I have explained to you, if the question not clear, write your assumption, clarify the question for them. Okay. So now I also have something to say over here, something to clarify. Even though the directors agree to pay interest on the 10% loan out of the profit for 31st May 2008, it has to be provided for in the accounts for 31st May 2007 in compliance with prudent concept. So like what I explained before just now, even though they said that must pay out of next year's profit, but the thing is, it has to be provided for. It has to be provided for in the previous year's accounts because long-term debt holders' interest is compulsory. Unlike preference dividend, preference dividend, the arrears will be taken into consideration only in the years where there is a profit available for appropriation, net profit for the year, accumulated profit brought forward. So let's say if this is negative, profit available for appropriation is negative. That means cannot pay any dividend, cannot pay any. The company don't have profit available to pay any preference share dividend or ordinary share dividend. Okay. Dividend on 7% non-cumulative preference shares for the year 31 May 2007 need not be paid, being non-cumulative. This is I'm just clarifying over here, just being a bit long-winded, but also being safe. Clarify the question thoroughly, like what I've explained to you. So part C says prepare the share capital and reserve of the balance sheet at 31 May 2008. So share capital and reserve 31 May 2008. So the company has issued 4 million ordinary shares. Okay. Okay. So the question says that the company issued 4 million ordinary shares. Then earlier on they have 600,000 ordinary shares. Okay. The ordinary shares is $1 each, so easy to count. So that will be 4.6 million. Okay. And 350,000 is this part. 350,000. Okay. It also purchased the net asset from another company for 800,000. So that means this is not very confusing. That means the company purchased 800,000 of net asset from another company by issuing 350,000 ordinary shares, $1 fully paid. Okay, so that means they take 800,000. This company take 800,000 of net asset from the other company, and give 350,000 ordinary shares to that company X previous shareholder. Okay, to the company existing shareholders lah. I mean, give 350 ordinary shares to not to the company shareholders. I mean, sorry, give to that company. So in that company balance sheet, it will be stated as investment. Okay, the investment in shares. Okay, so this is not very confusing. So that means in this company, in our Phoenix Limited, our current this company, we are actually issuing 350,000 ordinary shares. So ordinary shares is 4950. Okay, so then this one 700,000, this one just is it remains the same one. It remains the same. Then this one this one also remains the same. Okay. Then share premium. Okay, share premium. Okay, so this one is 208,000. Okay, so that means in other words, you see the 300,000 you issue for 800,000. I mean the 350,000 ordinary shares is the value is 800,000. So that means how much is the premium minus 350? The premium is 800 minus 350, that will be 450,000. Okay. Uh, Share premium account. Okay, 800,000 minus 350. So 800 refers to this one minus 350. Okay, 800 minus 350. Okay, so I'm calculating the premium. So you get, where is the 800? 800 is this one, 800,000, and minus 350 plus the original share premium 208 plus 208,000. Okay, 208 is here plus 208. So this is the share premium account balance. Okay, 197,500 is here. So this is my share capital and reserve total. Okay, so explain what is meant by control of a limited company and state where control lies in the case of Phoenix Limited. Okay, so these kind of things I have explained in part 1. Okay, so I don't need to read the question to you. You can read this theory question on your part. Okay, so that's all. So uh, practice all your question thoroughly. Thank you for watching, and bye.